The feds are finally slashing rates, but mortgage rates are going up. Last month, a 30-year fixed rate mortgage was about 6.4%. This month, it's 7%. Make it make sense. Mortgage rates are not based on Fed rates. It's always something. The Federal Reserve rates are more for short term lending, short term loans like your car loan, your credit card loans. But mortgage rates, which are long term lending, 30 years, we may be going up to 40 years now, those are based on Treasury rate. I know. In simple English, the Treasury rate is how much the government pays you to borrow money. When you buy a bond, the Treasury bond, the interest rate is set. It's how much the government will be paying you to borrow that money. The 10-year Treasury rate is for the 10-year Treasury bond. Well, what does that have to do with your mortgage? Glad you asked. When you get your mortgage, your home loan, your lender, your bank, they end up bundling all these mortgages that they've underwritten and they sell it to investors in a secondary market. Well, these are the same investors and market for treasury bonds. So to make this bundle of loans very attractive, they have to stay in line. They have to yield the same profit over time, like the bonds, the treasury bonds. So if the treasury rate goes up, the mortgage rates go up to keep these loans more attractive or to keep them competitive with the treasury bonds. If the treasury rate goes down, the mortgage rates go down. But wait, there's more. The treasury bonds, the US treasury bonds, are one of the most, if not the lowest risk investment option you could ever make because they are backed by the US government and you can liquidate at any point. Makes it a great, great investment option, low risk. Your mortgage loans, on the other hand, these bundles of home loans, risky because what makes these mortgages good is simply the fact that you pay your mortgage on time, as you said you would over the next 30 years. Well, you are risky, regardless of your credit score, you're still risky. Right? Anything can happen. So, to compensate the investors for taking a riskier option to make this riskier option more attractive compared to the bonds, mortgage rates are usually a point or two higher than the treasury rates. Right now, the rate for a 10-year treasury bond is at 4.43%. The current rate for a 30-year fixed rate mortgage is 6.8%. Could be 7 for some of you, depending on the lender, depending on your credit score, but you get the point. If you're like me right now, you're focused on, well, how can we get the treasury rate to drop? What needs to happen so we can get this mortgage rates decrease, right? There are several things that can affect the treasury rate, inflation and whatnot. A major part of it is the economy. If investors are worried about the economy, they're uncertain about the economy, they're more likely to invest in bonds. They're more likely to buy bonds where they can park their money and know they're guaranteed X return after a decade, after 20 years, right? When that happens, there's a high demand for bonds. And what happens when there's a high demand for anything? The price goes up, right? Well, when the price of bonds go up, without going deep into terminology and the economics of it all, when the price of a thing, the cost of acquiring a thing goes up, it eats into your profit margin, your yield. So when the bond price goes up because of demand, the profit goes down, the yield goes down. And when the treasury yield goes down, our mortgage rate goes down. But when investors are optimistic about the economy, they're more likely to go ahead and invest in riskier options because more risk, more reward. And if they're confident about the way the economy is going, then they're more likely to go ahead and invest in that, which means demand for bonds will decrease. And as you know, supply and demand, once again, when demand decreases, what happens to the price? It goes down to make it attractive, right? When the price goes down, your cost of getting it goes down. The yield, your profit margin, I'm using simple English, goes up. And when that goes up, when the yield goes up, our mortgage rates go up. At this point, you're probably thinking, but the economy is not so swell, right? We have a handle on inflation, but it's not yet the best. And we have a new administration coming in, new policies. It's not like things are certain. There's a lot of uncertainties going on. Heck, the feds have reduced rates to try and keep things going. So, with the rate reduction, does this not have any impact on treasury rates? Shouldn't that be decreasing as well? And based on my previous explanation, shouldn't investors be buying a lot of bonds right now, and which would mean the yield will go down and the mortgage rate will go down, whatever has been explained. The reason why the decrease in the Fed rates did not translate to the Treasury rate is because we all knew there would be rate decreases this year. You knew it, I knew it, Treasury bond knew it. So when they set that bond price, which would affect your profit margin, the yield, they accounted for the fact that the Feds will be cutting down rates. So when the Feds eventually cut rates, which they didn't even cut it as much as expected, it had no effect on the Treasury rate because it was already factored in the current price. So the bond price remained as is, the rate remained as is. Hence, therefore, mortgage rates are increasing. It's always something. It's always something. But if you're in the market to buy a house, if you're waiting on the interest rate to decrease before you buy a house, listen, it's a gamble. It's not looking like anytime soon, but you never know. Never say never. You know, if we've learned anything over the last 4 years, heck, if we've learned anything over the last week or two, is that anything can happen. So never say never. The rates could go down. Something could pop up and the rates will go down. But just know it's a gamble. If you're wondering how we made our decision, the things we considered that led us to buying our house in this Jesus take the wheel housing economy, housing market, then go ahead and watch this video and hopefully that will help you in your decision making. Good luck. Thank you so much for watching. I will see you in the next video. Bye.